Welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka.
And I'm Santosh Nair.
Well, the markets, of course, took a U-turn and a sharp one at that, Santo. Given the fact that we hit a new high on the index, on the Nifty, it came very close to that 22,800 mark. But soon after hitting a fresh high, we saw a very sharp turn, and the Nifty at one point was down. In fact, it had even broken below that 22,400 mark. But we did manage to pare some of those losses and ended just a shade below that 22,500 mark. Nevertheless, it was a triple-digit loss on the index today, 180 points or thereabouts. That's the kind of cut we saw on the index. Sensex as well, at one point it was down 1,200 points, but just about managed to end near about that 73,900 mark. Broader end of the markets managed to hold out in comparison with the benchmarks. They were outperforming. So the mid-cap index was down 0.3% vis-a-vis a 1% cut on the Nifty. Sectorally, most of the sectors were trading in the red today, led by banks, IT, autos. But pharma, managed to do fairly okay in a very weak market. India VIX deserves mention. Santo 8%, but over the last 5 sessions India VIX has jumped over 35%. That's the kind of volatility we are witnessing at highs, Santo. But what is the sense you're getting, Santo? Should we brace up for sell in May and go away, or do you think that that's too harsh right now and it's just a bout of profit taking that we are witnessing at highs?
I think, Nandita, right now more than anything, it's what we're seeing is the sheer force of liquidity flows. About 20,000 crore coming through SIPs alone, and this is not counting the money that flows directly into the stocks coming from retail investors itself. Also, then there are family offices, PMS. So none of this amount is captured, but this kind of money flow explains why, despite steady selling by foreign institutional investors, we have been seeing the market trending higher. And also, if you notice today, mid and small cap stocks managed to hold ground despite the selling pressure in frontline stocks. So clearly, it does look that at this stage, it's not so much about valuations, but it seems to be more of a left out feeling. So the moment you see a correction, like we saw the Sensex drop about 1,000 plus points intraday, but it did manage to trim some of those losses. The Nifty 2 was down by close to around 300 points at one stage. The Index 2 managed to recoup some of the losses. So, Nandita, if you ask HNIs, they'll say that it really doesn't make sense buying in this market because you've got a major risk event coming up. And although market has already factored in that the NDA will be returning to power, there's still some bit of a slight nervousness on what the margin of victory could be. So given these factors, and also because stock prices have run up so much, it would make sense probably to wait a little and then jump in after the election results are out. But what we are saying is what we are seeing right now, I think, is too much of that left out feeling among retail investors, which is leading to this kind of frenzy in the market. So occasionally, yes, you will see some bouts of profit taking, but it's very early to call for a trend, because so far you've seen the market come back strongly after every correction, and who knows, probably this trend could continue.
Right, so in the run-up to the June 4 event, do you think we'll be range-bound? As you said, there is no clear trend really. But another point I want to make is that foreign investors have been consistent sellers right through this year. So do you think once that event is out of the way, we'll see more foreign money as well coming into the market, which could again drive up indices higher?
I think, Nandita, once the major event is out of the way, typically then the focus once again shifts to fundamentals, and then it will depend on where the prices and valuations are at that point in time. Let's say where we to see a sharper correction in the run up to the budget, to the election results. We still have about a month to go. Then probably if the election results are better than expected, you could see a fresh round of buying coming in. But if valuations continue to be around these levels, at least it's very hard to see institutional investors buying very aggressively. Already even domestic funds, although the numbers are positive, what we are picking up from the market is that they too are being quite selective. Most of the action right now is happening in the mid and small caps, and that is mainly because of retail buying. If you notice, the mid cap index was down by less than 0.5% compared to close to about 0.8% cut in the main indices. This is a situation where actually it makes more sense to buy frontline stocks where the valuations are reasonable, if not downright cheap. But what we are seeing is exactly the opposite. Frontline stocks are continuing to take a hit, while at the same time more investors are rushing to buy mid and small cap stocks.
Right, just want to point out some of the movers and shakers in today's session. On that note, Santo, among the key losers, we had frontline names like Reliance Industries, HDFC Bank, and these were among the top contributors on the downside on the Nifty. Airtel, Nestle, Kotak Bank, which by the way reports its numbers tomorrow, were also on the losing end. On the gaining end, quite a few stocks, Coal India, one of them, numbers came out yesterday reacting to that. You had Grasim, Dr. Reddy's, ONGC, Hindalco, Bajaj Finance, of course, lifting of RBI curbs comes as a positive for the stock. The stock did rally somewhere around 7% intraday trade, but of course, in keeping with the general sentiment in the market, at least in today's session, it came off the day's high. From the broader end of the markets, we saw 10% cut on Coforge. Poor earnings, not exactly earnings, margins disappointed, and of course there was a big overhang of an acquisition that it announced. We'll talk about that in just a bit. Spark, it managed to cut its losses of 14 days yesterday, but today back, on the losing side. Carborundum and MRF, which reported a weak set of numbers, also among the losers on the Nifty 500 index. On the gaining end, you had Blue Dart, Hindustan Zinc and Ajanta Pharma on the back of good numbers, as well as that buyback announcement, push the stock higher in trade. But on that note, Santo, let's talk about some of the stocks that are on our radar. I think for you, Coal India is one stock that you are picking in today's, in today's show. Of course, numbers were good. Tell us why have you put that stock on our radar this afternoon?
Well, with Coal India, clearly the play right now is that there's strong demand coming in from the power sector. So that's the key trigger for Coal India at this point. But besides that, Coal India has also been doing quite a few things. It's focused on ramping up its volumes. Now for FY24, the company logged record sales of about 753.5 million tons. It accounts for close to about 80% of all the coal market in India. And besides that, it's also undertaken a lot of cost saving measures, and according to Anand Rathi, the cost saving measures along with evacuation and infrastructure projects that Coal India has invested in will lead to a significant improvement in margin over the coming quarter. So you have strong demand coming from the power sector, that's one, and then on the other hand you also have the company trying to improve its margins through cost cutting measures. So put these both together and clearly it's not very hard to see why the stock has been climbing. Also the latest quarter numbers were quite strong. Jefferies is also one of the brokerages which is bullish on the stock. Besides that, you have Anand Rathi, ICICI Securities and Motilal Oswal, all which are bullish on the stock. Now there are some risks as well. One is that clearly coal is seen as a polluting fuel, so time to time there are concerns over that. So should those concerns relating to ESG surface once again, then probably you could see some kind of profit taking there. And at the same time, there's also a lot riding on demand from the power sector. So should that demand not materialize, then that's also a downside risk. Besides that, domestic coal mining activities, if that sees a sharp surge, probably that will cut into Coal India's market share.
Right, of course, we've all seen how PSU stocks have been outperforming, and that has been the flavor over the last year or so. And even on a YTD basis, Coal India, has done fairly well, 25% gains. A
little bit of context there, Nandita, but for someone who had subscribed to the IPO of Coal India in 2010, the gains are not very big.
Okay.
Right, the stock has not even doubled. Of course, probably if you factor in all the dividends paid out, then the returns are much better, but it's now almost 14 years, so the returns have been quite subpar in that sense. But anyone who has invested in the last 4 years, they are sitting on a good pile of profits at the moment.
I think PSUs were one of the most avoided sector and neglected sector till now, so to say. It wasn't really a darling of the stock market, but over the last 1.5 years, I think we've seen a lot of action in some of these PSU stocks, including the likes of power stocks, defense stocks, and what have you, right?
Right. But with Coal India, I think the concern is different. It's not just about governance, but it's also the fact that there is a lot of international pressure to reduce use of coal. So I think that is the bigger worry for Coal India, because it's being seen as a sunset industry.
Well, that was about Coal India, but let's talk about the other stock that was making headlines today, Bajaj Finance. Of course, a big positive coming in, in the form of lifting of regulatory action that RBI had taken back in November last year. In fact, it had, banned the company from, disbursal of loans under two of its digital products, EMI cards, as well as e-com. Now, that was a big near-term overhang for the stock, and brokerages were waiting for this regulatory overhang to, kind of lift, and that was being viewed as a positive catalyst in the near term, and that has happened. But this is something that the management had already indicated would happen soon, because they had taken the remedial actions and they had requested the RBI to lift the ban, and which is what the RBI had done. Of course, the company has taken remedial measures, as I said, but the numbers had also come in, and the AUM growth was pretty good in the fourth quarter. But what disappointed Street was the fact that it had given a guidance of 30 to 40 basis point cut in margins for FY25, and elevated the credit costs also came in as a dampener. So those two factors did weigh on the stock, but as I said, this particular lifting of regulatory hang bodes well for the stock, which is what brokerages are also maintaining, because CLSA has said that now that the curbs have been lifted, focus will once again shift to fundamentals like margins, like asset quality, revenue growth, and the likes, and the company is no longer in RBI's bad books. That's one good positive. And according to CLSA, the impact on profit before tax for Bajaj Finance due to this ban was somewhere around 4%. So now that regulatory overhang is out of the way, so profit growth and FY25 outlook should improve going forward for the stock. Jefferies also has a buy rating. It has retained its positive stance, target price at 9,270 or 260 rupees a share, I beg your pardon. And it has mentioned that the lifting of the regulatory overhang just within 6 months is a big positive, and it sees a profit CAGR of 24% over FY24 to FY27 for the company. MK has also said that this lifting of ban has increased confidence in the FY25 outlook, and I also want to point out that out of the 37 analysts who are covering the stock, majority of them, 29, have a buy call, while only 3 of them have a sell call. So Bajaj Finance, of course, has been one of the leading NBFCs of the country, so of course play on consumer credit, right? So that is reinforced by the fact that regulatory issues are now out of the way.
Well, and the last stock on my watch list this afternoon is Hindalco. With a very strong comeback by the stock over the last couple of months. It was sometime in mid-Feb that the stock took a beating after the capex spend at Novelis turned out to be higher than what the market was anticipating, but now that seems to be a thing of the past. So main reason driving sentiment for Hindalco right now is that aluminium prices have firmed up of late, and the outlook, near-term outlook for the metal is quite positive at this point in time. CLSA has retained its buy rating on the stock, but has upgraded price target to 770 rupees. It has also slightly raised its estimates for Novelis. CLSA sees Hindalco's, or rather has raised Hindalco's estimated EBITDA for FY24 to FY26 by 4 to 13%, citing higher aluminium prices. Now, Nandita, there is one more reason why there is a lot of bullishness on aluminium, which is that copper prices have risen quite sharply and are expected to continue their rise. Now, the thing with copper is that although it's a better conductor of electricity compared to aluminium, it's also much more expensive, and that's one of the reason a lot of analysts see that there could be a switch to aluminium, because it's much lighter and also it's cheaper. And also the differential between copper and aluminium, usually it's 3 to 4 times, copper is always 3 to 4 times higher than aluminium, and right now we are seeing that trend again, where the differential has increased a bit, because of which analysts feel that one of the two has to happen. Either copper prices have to come off a little bit, or probably aluminium prices have to go up a little more. So I think that the street is right now betting that probably you could see aluminium prices climbing higher.
Right, and I think metal stocks in general have been doing pretty well, Santo. We've had some good or positive economic data coming out of China as well, which has boded well for some of the metal names, and Hindalco seems to be one of them. Of course, we saw that Bay Minute project, coming as a dampener. There were reports of cost overruns at Bay Minute, and which was quite a big setback for this stock, because it did see a 10% downtick on a particular day. But right now it seems to have come off that negativity, and in tandem with other metal stocks, Hindalco has done fairly well. I think even on a YTD basis, we've seen good gains for the shares of Hindalco. Particularly, if you look at the last 1 year performance, it's up somewhere around 45% or thereabouts, Santo.
Yeah.
With that, the last stock on my list is of course Coforge. That stock dropped somewhere around 10% in today's session. Santo, of course, there is this overhang of margins missing estimates, but of course the larger concern is the acquisition that they have announced, Signity Tech. That's the company that they want to acquire, and also the fact that they haven't really given a guidance for FY25, which means according to analysts there's greater uncertainty in the current financial year for the company, and which has of course made the analyst community very cautious about this stock. In fact, most of them also pointing out that they'll be of course coming out with a QIP to raise funds for this acquisition, right? So that will also be an overhang in the near term, that analysts are pointing that out, and they are saying that the benefits of the acquisitions will be far outweighed by dilution. The stake dilution that the company will do via fundraise. So a lot of these Jefferies and other brokerage houses have downgraded the stock. In fact, Jefferies has downgraded the stock to underperform, and target price has been cut to 4,290 rupees per share. They've also cut their EPS estimates by 11 to 16% to factor in slower growth and lower margin as well. They're saying that continued disappointment on the margin front warrants a de-rating on the stock, and of course this acquisition related uncertainty also warrants a de-rating. Aside of that, Nuvama still maintains its buy call. Target price although has been cut to 5,850 vis-a-vis 7,000 rupees. It has also cut the target multiple here to 27 times from 30 times, and they've also said that they would have preferred an acquisition with capabilities in the new age tech domain, which is something the company hasn't done. And as I mentioned, the street is concerned about the benefits of this acquisition far outweighing the dilution that the company will see. On a YTD basis, of course, the stock has shaved off 25%. I would just want to point out that the year so far has not been too good for the IT names. Ever since global giants like Accenture cut their guidance, we've seen Indian IT firms take it on the chin as well. Numbers weren't really anything to swear by as well. So all in all, things not looking too good for IT names, and Coforge, one of them, of course, margin disappointment, as I mentioned. Just want to mention that till about late last year, it was backed by PE giant Bearing EQT, but they had exited their stake via the biggest block deal, one of the biggest block deals of last year, back in November, if I'm not mistaken. And of course, since then, now of course they have exited this stock, but of course, numbers have disappointed, and we've seen it being reflected in the stock prices as well, Santo.
Well, clearly, I think the sentiment for IT sector in general continues to remain a little cautious. The commentary has not been very bad, but given that we've seen the stocks post very sharp gains over the last couple of years, and valuations still don't seem to be fully factoring in the fact that growth in the coming quarters could be a little slower perhaps, and that's why the market is understandably nervous on it.
Well, then I think this wraps up all the stocks that we were supposed to be talking on the show about. But of course, with this, it's a wrap on this edition of Closing Bell. It's a weekend. You guys have a great weekend, and come back and join us on Monday morning with the markets again. But from me and Santo, have a great weekend, and then rest it out and come back and join us on Monday. Thanks a lot for watching.